most of the loans we buy are 10 years old. So these people have so much equity. If you have all this equity in your house, are you going to let someone come in and foreclose on you, or are you going to fight tooth and nail to keep the house?
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy, and I'll be your host today. And we're going to focus on something new today, note investing. And I am really excited to have a friend of mine, Chris Seveney, on with us. And he is the CEO and founder of 7E Investments. And he spent about 25 years in construction and development prior to getting into that space. So welcome to the show, Chris. Excited to have you here.
Thanks, Randy. Excited to be here.
All right. Well, let's jump into the world of note investing. Can you tell us a little bit about yourself, kind of your path to where we are today, and jump into this note investing thing?
Yes, I actually chuckled when you said the gentle art, because there's nothing gentle in real estate in my mind, investing. So let's I'll backtrack a little bit. Age myself. I graduated college in the mid to late 90s and started working for a large commercial general contractor at that time, and got to build some really cool projects, high-rise multifamily buildings, office, retail, you name it. I've pretty much built it. But
Okay.
after about 15 years of that, you kind of get a little burnt out. So I moved to Washington, D.C. I was originally from New England area, and I'll say I went over to the dark side, which from a contracting side, that is going to work for a developer.
Sure.
Probably the best move I ever made, because everyone I was working with was very entrepreneurial. And my supervisor at the time said, "What do you have for real estate?" And I'm like, "Nothing. I got a 401k. And he basically, first he laughed, then I think he cried, and then he scolded me in regards to getting my own portfolio. And my wife and I, in 2013, built our primary residence and ended up having a boatload of equity because we acted as a general contractor on it. And that started my personal real estate career. And that kind of is what launched 7E Investments. In 2015, we started buying some local real estate in Washington, D.C. area. And we were doing, the bigger pockets BRRRR strategy, where you buy, rehab, rent, refinance, that whole thing. And we did several of those, and we were able to get all our money out. It was great. But we also had 2 little kids at the time. And my wife basically said, "Okay, we're done." We didn't have the time, honestly, to do it.
Sure. And you were working a full-time job.
I was still working a full-time job for a real estate developer. And I was managing at that time a 60-unit condo complex where the average unit was a little over $2 million. And, a lot of the who's who of Washington, D.C. were moving into this building. So working with people like that also, they are highly demanding, to say the least.
Yeah, I bet.
But what I ended up doing was, the stubborn person I am didn't want to give up. So I ended up falling into note investing. And, most people, they hear about it and are like, "What is that?" And I said the same thing. And I was actually, as I mentioned pre-recording, I was kind of ticked off when I found out that this existed, because, it's such a fun business to be in if you like conflict, I guess. But, so most people think of private lending. Okay, you give somebody a loan and you just collect the payments and you act as the bank. What mortgage note investing is, or what we do, is different, where we're buying residential mortgages. So if you own a house, we may buy your mortgage from the lender and just step into that position. Now, you'll think, okay, that doesn't seem interesting. But our primary focus is on distressed mortgages. So we're buying loans from banks and hedge funds for people who are delinquent on their mortgages. And that has been our primary, I'll say bread and butter since 2016.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So yeah, that's interesting. I've not dealt in this space, and you had mentioned that I'm going to be excited about this when I hear about it. So,
Yep.
so I'm thinking what comes to mind first is all those years that we had coming into the last year or so. There's a lot of
Mhm.
people with very, very low loans, so 3, 4, 5% loans,
Mhm.
and I can't imagine anybody ever defaulting or going late on those loans. Like,
Mhm.
what are the actual results in that space? Are those good mortgages to get, or are those less from the last few years?
Yeah. Well, when you look at the numbers, the mortgage industry's, 13, $14 trillion industry. So, and you look at today, we're at all-time lows or 2 to 3% default rates. We still got 400 billion in defaulted loans. So it's still very low rate, but there's still a lot of them out there.
Okay.
Now, you mentioned, a lot of loans at 3, 4, 5%. That might be for somebody like you or I who might have impeccable credit. But a lot of people either be coming out of 2008 and, buying houses in 2011 and 12. We see most of the loans we see were originated at rates anywhere from, 5.5 up to 8%, because these people may not have had that 750 credit score. They may have been, high fives, low sixes,
Sure.
in that range. So that's where we see a lot of the loans that are delinquent in that area. Most of the time, like I said, the 3%er, loans, you usually don't see a lot of those.
Got it. Okay. So now, and I suspect you're not buying onesie twosies. You're probably buying tranches of loans when you do buy them, right?
Correct. I mean, we have bought one-offs in the past. And of course, when I got started, that's how I started was, started buying, one at a time and just kept scaling. But now our preference is to buy, anywhere from, 10 to 100 at a time.
Wow. So you're okay. So you're having to buy, I mean, those are big dollars, obviously, that you're
Mhm.
buying, and you're buying them. I suspect these are distress or these non-performing loans, people that are not paying their mortgages today, or
Correct. Yep. So they're distressed or non-performing. They're typically more than 90 days behind. And one of the questions that I love to ask people when I come on podcasts is, I push the question back is, what do you think the average delinquency, or how many months behind do you think the average loan we buy is?
well, you said at least 90 days, so I'm guessing 90 days to a year, probably, right?
3 to 4 years.
Is it really? So banks will hold on to loans 3 to 4 years before they sell them off or write them off. That's amazing. Why would they
And
not? Why would they not just pursue evictions or something like that?
so banks, and if you've ever had to deal with a bank and you have a business,
Yeah,
getting stuff done through a bank is similar to almost like buying a car. You go there knowing you're
sure.
going to lose an hour, and on
Yeah,
a very simple process. Banks, you know, are typically sometimes inefficient. I like to compare them to, think of a car on the assembly line. Everything goes well on the assembly line. They just chug away. The moment
yeah.
something happens on an assembly line, all hell breaks loose. And think of that
Okay,
with
sure,
a
sure.
loan. And banks only have so many people. And what they'll typically do is when a loan goes non-performing, they'll do like a 60-day sprint of trying to get in touch with the borrower, trying to work something out. And then after that, it's almost like it sticks in a file, and they just send statements and they keep passing it off to somebody else in different departments.
Wow,
So,
wow.
I mean, we've seen loans. We have a loan right now that is over 11 years without, payments on it. So
Okay,
it's, they're very inefficient. So I love mentioning that because most people think that, oh my God, I miss a payment, I'm going to come get my door beaten down and thrown out.
sure,
You know,
sure.
with a bank, a traditional bank, that ain't happening because they don't even know what they have half the time.
Yeah, that makes sense. Interesting. Yeah, so I'm curious, is this all of the major banks, or are these just some of the smaller? Are there certain banks that you focus on because
Mhm.
of those specific details, or?
Yeah, so we typically don't buy directly from a bank because a lot of the banks will either take it and securitize these loans, which then they have to come out of security. But in most instances, they get sold to larger hedge funds and eventually make their way down the pipeline, like, BlackRock to another fund to a billion to a 500 million, and the tranches. Where we do see some banks sell are they will typically use a M&A company. So
Okay.
again, banks don't know who's going to buy these things, so they'll go to an M&A company who is called also a whole loan trader, and then
Okay.
through them we'll be able to get portfolios. For example, the Signature Bank. So
Yeah.
Signature Bank, their portfolio just sold. It was broken up into many different tranches of different assets, and they went through a whole loan trader. The FDIC did. They went through a company basically who's good at the M&A side and getting rid of that stuff to get that
Interesting.
out the door.
So the original loan holder sells this off to another group at a
Yeah,
discount, who sells it off to another group at a discount, and then at some
yeah.
point
hmm
you step in and you're buying. But would you say the average is closer to the 3 or 4, or what's the average um, delinquency on the loans that you're
Yeah,
buying?
the average is about 3 to 4 for us. Three to
Is it
four
really?
years. Yep.
Okay.
Oh,
And then so clearly you're buying those at some sort of discount, I suspect.
correct.
Is it 10% off, 20% off, 50% off?
30 to 60, depending on the state. And, understanding real estate and investing, time is money. So time value of
Sure.
money. And
Okay.
the interesting thing about note investing, which is different than I'll say being a landlord, is, for a landlord, most of the laws are the same. Evictions might change slightly. But when you're a lender, the foreclosure process is very different state by state. So some
Interesting.
states you can foreclose in a very short period of time. And then
Okay.
you have, Georgia, Texas, even California actually is pretty quick from a time frame. You can be in and out in, 3 to 6 months. Then you
Okay.
deal with states like New York, Hawaii, others that it can take 4 to 5 years to foreclose.
Wow.
So,
Okay. So,
mhm.
so then is your business model, is it to buy these loans and then attempt to, I don't know what the term is, attempt to cure those loans and get them paying
Yep.
again? Or
Mhm.
is the goal ultimately to go through the eviction process and then sell the assets?
Yeah, typically our goal is to get the borrower on a new payment plan. So we like to explain it to people. Again, people like to fix and flip properties. You have a property that's dilapidated, so you can buy it at a discount to fix it and then resell it. We do the same thing, but we're doing it with the borrower. So, we don't own the property because we're the lender, but we like to try and do a workout with the borrower where, okay, let's get a down payment for them. Let's get them on a new payment plan. And then after a period of time, that loan will be cured and considered performing. That then
Okay.
will sell at less of a discount.
Got
So,
it.
so
Okay.
that's kind of that process. And the reality of it is today, when people say, oh, well, I want to get in this to foreclose, we foreclose on less than 10% of our portfolio. And
Love it.
typically it's because the person's deceased or they don't want the property.
Okay.
And the main reason why, Randy, is if you think about what happened to real estate values the last 3 or 4 years, most of the loans we buy are 10 years old. So these people have so much equity. If you have all this equity in your house, are you going to let someone come in and foreclose on you, or are you going to fight tooth and nail to keep the house?
Absolutely. Yeah. So really, I mean, you guys are bringing kind of a good news story to the owners at that point
Mhm.
where it's, your goal is just simply let's get a few dollars. You got to have
Mhm.
some type of a down payment just so
Yep.
we know that you're serious about paying your mortgage. And then
Mhm.
let's get you on track and get some
Mhm.
history on this. And then
Mhm.
essentially you're in good standing and the home is yours and everybody goes on their happy way, essentially. Right.
Yeah. And then, what do most people do after 7 years? They either sell or refinance. So,
Okay.
or we sell the loan. I mean, we typically will keep our loans for about 18 months to 2 years is what our life cycle is. Some a little longer,
Okay.
some a little shorter, but that's a typical life cycle.
Interesting. Yeah. And I'm guessing, so you buy at call it a 30% discount and then you sell it at a 20% discount. And the variance or the arbitrage there is the profit that you
Mhm.
and your investors get to share in then, I guess.
Yep. And when you think about, a mortgage, payment. We collected payments during that time, but where's most of your mortgage payment go? Interest. So their balance is, I mean, we collect all that money, but the balance is barely paid down. So so that's part of that whole process as well.
Okay, fantastic. Yeah. So it's interesting when I've heard about note investing in the past. I thought onesie twosie. I've heard about buying in tranches. I didn't really understand the mechanics behind it. So can you walk through like an example of an asset? Like you get a loan that's a $200,000 loan, and then you buy it for X amount, and then sell it for X amount, and what that whole process could look like?
Yeah. So I'll try and keep the numbers as simple as possible.
Maybe
so
your average deal, right? You probably know averages pretty well, right?
Yeah. So our average deal right now is a $160,000 loan balance.
Okay.
And we are paying approximately about $110,000 for that loan. So they owe 160. We buy it for 110, and the property itself is worth about 400,000. So when we look at from an investment perspective, the loan to value or a risk profile, and we also, as a lender, we don't take on debt. So our investors are our investors. There's not a capital stack of 70% debt in front of them. So we like to try and keep our loan to value under 40% on a lot of these loans, or investment to value, I should say, below that. So in an instance like that, so we just did an example of a workout where the borrower's payment is $1,300 a month, and they were 18 months behind. We took a payment of $6,500 down. So we took 5 months of payments from them, which they just literally paid us on Friday. And then in 6 months, if they make 6 consecutive payments, we will re-amortize the loan and we'll roll the past due amount and add it to the new principal balance. So their principal balance will go up by $10,000, but now the loan is brought current, so they don't have to deal with late fees or any other penalties. And then it also, from a credit reporting standpoint, it allows them to rebuild their credit, which of course helps us when they're paying, because then it gives them the ability down the road to, of course, try and refinance the loan. And the other thing about refinancing, when you look at some of these loans, is people not only look at the rate, but they look at what their payment is. This loan only has about 10 years left. If this person went and refinanced it at a 30-year rate, they'd probably save about $500 a month. So it's part of that whole equation as well. But that's, and then our goal will be to try and sell this thing down the road for, they owe 160. So probably 10 to 15% discount on it. So somewhere around 135 to 145 would be what we try and.
Well, okay. So you sit on it for 6 to 9 months, and you end up making ultimately, $25,000, $30,000.
Yep.
Wow, fantastic. So essentially, going back to that initial analogy, you're flipping without ever having to own it. You're adding value because you're moving them from not paying to paying. And then when you sell it on the back end, you still are selling it at a discount. So there's probably a ton of banks that want to buy that performing loan at that point.
Other funds, IRA investors looking for cash flow. There's a lot of people on that back end. And, one thing we'll mention is, it sounds nice and easy. Typically this process will take 4 to 6 months to get them to come to the table, because they are of the mindset of the banks have left them alone for the last few years. So they get a new statement, they just ignore it and don't do anything. A lot of times we'll have to get, the letter from the law offices of ABC. That's usually what wakes people up to get them to come back to the table.
Got it. Because they just know it's been 4 years and they've been getting all these threatening letters and nothing ever happens anyways.
Yep.
Okay. So let's talk about the guy that doesn't finally return the call or the email or the letter.
Yep.
Do you guys start going down the foreclosure path, and does that have kind of a predictable response?
It does. So we'll, go down that foreclosure path, and then, typically one of 3 things happen. A, they bury their head in the sand and get foreclosed upon.
Sure.
B is they will, beg for forgiveness the last second and try and work something out.
Sure.
Or C, they'll file bankruptcy. And in most instances, C is the response that way they will do, especially if they truly cannot afford the property. And again, rarely do we foreclose the first time around. If someone can't afford it, they will go bankruptcy in that first deal.
And then in bankruptcy, they lose the house anyways?
No, in bankruptcy, it's actually they're protected. So what will happen is, so let's say a borrower is $60,000 behind. What the bankruptcy will do, and this is not going to get too deep because there's multiple bankruptcies, but they'll take that 60,000 and they amortize it over 60 months. So they'll say, okay, now you have to make your regular mortgage payment, but the bankruptcy plan will now let you pay that 60 grand back over 60 months. So you have to pay an extra $1,000 a month. It may garnish the wages, but we've seen plans where the borrower made $20,000 a year and basically had a $900 mortgage payment. They're $110,000 behind. So they had to pay essentially $3,000 per month in bankruptcy where they made $20,000 a year. The funny thing is the court approved that plan.
It doesn't make any sense. The math doesn't work, right?
No. So we basically, my attorney's like, there's no use fighting it because it's just going to drag it on. Just let the guy fail.
Right.
And, I joke, I'm like,
end.
yeah. And I joke, I'm like, okay, if any bank went and gave somebody who made $20,000 a year a loan that cost $3,000 a month, they'd be in an orange jumpsuit. But,
exactly. Yeah.
The bankruptcy court, it's okay for them to do it.
Yeah. Well, very interesting. I've learned a lot already, and we're just 20 minutes into this. But I've got to ask the question. This is a podcast around passive investing for the newer passive investors.
Mm-hmm.
It sounds intriguing. Clearly, I can see how you guys are making dollars. But what does that look like for the passive investor?
Yeah. So with passive investors, the way we structured our fund is, we don't charge fees to the fund. So it's very different than a standard, I'll say multifamily where you get acquisition, disposition type of fees. We have a team that manages our portfolio where we're salaried employees. So we get paid a salary and we don't get, any upside until after the investors are paid. So try to make it a win-win. Investors get between 8% and 11% is the returns that the investors get. And one of the things we did structure it a little differently is anybody who invests in a lot of debt funds, you get, for me, I'll call it the dreaded K1. And a lot of times it's taxed as ordinary income because it's considered interest. We structured it as a C corporation. So we actually issue a 1099 dividend form, which, is taxed as if, you own like Apple stock or anything else. So if you hold it for a period of time, then it is, I forget, I think it's qualified dividends. But of course, I'm not providing any tax advice.
Sure.
So, that also, provides a nice benefit to the investors because they're not waiting till whenever to get a K1. We can issue those forms in January and they're paying, they're not paying that ordinary income tax rate on it. So it's a nice little benefit there for the investors.
And they pay capital gains then is what it is?
Yeah. So they would pay, 0, 15 or 20% depending on, which bracket they're in.
And it's long-term capital gains. It's not short-term capital gains?
Long-term, again, if, we have a 3 to 4 year hold period. So if you're in it for that long, then, but I think what's the statutes, 90 days, I think, or something like that after 90 days because you're buying stock in the company. Again, you're not owning real estate. You're actually buying a share of the company.
Got it. And so do you get monthly or quarterly distributions or what does that look like?
Monthly. So we issue monthly distributions to our investors. And,
and can they reinvest?
We don't have a drip, because of having audited financials and having to report to the SEC. It is extremely painful and would have basically tripled our auditing and accounting costs. So
sure.
But, so if somebody invested today, they would start accruing the interest on the first day of the following month. So at the end of next month, they would get their first distribution. And we did what's called a Regulation A+ offering. So
Yeah.
we allow accredited, non-accredited, and our minimum investment's only $5,000.
Okay, so non-accredited investors as little as $5,000 investments.
Yep.
Unreal. Okay. So yeah, so that's a different exemption than the 506Bs and Cs that I'm used to dealing with. So
Yep.
can you talk about that a little bit more? Was that why don't more groups do that? Is it a rather lengthy process, or is it difficult, or cost more?
It absolutely costs more. It costs about 10 times the cost of putting together a 506C or 506B. From a time frame, I started in November of 21 with the attorney putting everything together. We submitted in April of 22 and got qualified in July of 22. So,
Oh
when
goodness.
you look at kind of doing your first 506C, you're going to spend 2-3 months back and forth with the attorney anyway. So,
Sure.
here it took us about 90 days to get qualified to the SEC. I think one reason why people didn't do it the last 5 years is because it was very easy to raise money,
Yes.
and they can get
Yes.
it from accredited investors, not have to, they could get those big checks, which would fill their coffers. For us doing a note fund, and again, look back at a few years ago, us trying to compete against a multifamily investor, especially a accredited one, we couldn't. And, just be frank, but we also tell people, hey, you got to look at risk profile and everything else as part of this investment. But by opening up our offering to lower minimums and non-accredited, where I can sit on your podcast and say, we can have non-accredited investors and not get, slapped on the wrist like you do with a 506B. It opened it up to a much larger audience.
Yeah, that's interesting. So I'm curious about what is, I'm sure you have a lot of details on your investors. What is your average investor investing? Is this liquid, meaning they can pull it out at any point, or is it something that you hold on to for a certain amount of years, or what are all those details?
Yeah. So our average investor, so we've got about between 500 and 600 investors right now in the fund. The average investment is a little under 40,000 per investor. We have a very high rate of reinvestment where people start with 5,000 and then basically, see, hey, is this real? And then, contribute more, which I think is actually a positive, because I'm an investor. And when someone has $100,000 minimum, I am very uncomfortable investing in that.
Me too.
$5,000, hey, $5,000 is still a lot of money, but I'm not going to, get kicked out of my house if I lost $5,000. $100,000, probably sleeping at the end of the street.
There you go.
From liquidity, I'll use the term, it's not liquid in the sense of there is between a 3 and 4 year hold period for investors. After that, you can pull it out. Unlike, again, I like to compare multifamily, where kind of you pull it out based off of when the deal exits. For us, we have that 3 to 4 year hold period, depending on, we also have a 506C tied to this Reg A. We try and get, 2 turns of the investment. So that's what, I mentioned, it's 18 to 24 months to turn assets. So we, had the investment structured to give it kind of 2 turns with the investors.
Yep. And if they've gotten 8 to 11% consistently over 3 to 4 years, odds are they're going to leave it with you unless the investment market looks very different than it does today. So even if it does, I would imagine. Okay. Yeah. Very interesting. I can understand why you were frustrated when you heard about this model after not knowing about this for a lot of years. It's just amazes me how many different ways there are to invest in real estate, whether either directly or in groups and funds like yours. I'm really intrigued with this. Where do you see kind of this market or this segment of the investment space going in the next few years?
Yeah, so it's interesting because we do like to think we're in a little bit of a niche space, because there are a lot of other debt funds out there that, and a lot of them are very good, and a lot of them are on commercial assets, and, they'll buy distress or performing, or they'll originate commercial assets. With us being in that kind of more residential space, we've created a nice little market segment of where, we want to get to about 150 to 250 million. Personally, I believe we're going to continue to see an increase in distressed assets. To give you an idea, Randy, of kind of the flow that we see, at the beginning of this year, we were seeing about 250 to $300 million of assets come across our desk every quarter. And that is performing, non-performing, the mix. In quarter two, we were seeing about 250 million a month. So from a quarter to a month. So now we're starting, in quarter four, we're seeing about 250 million a week in assets.
Oh my goodness.
And we're seeing a lot of interesting types of assets. So one thing, for example, there's lien priority. So there's a first mortgage and people might get like a line of credit, which is a second mortgage. We have seen over the past month, probably over 5,000 defaulted lines of credit come through. And most of them were from COVID. And most of them, we actually bought a very small pool of like 15 of them. And what these people did was they took out a line of credit because they had a huge bump during COVID, pay off all their credit card debt because we see their credit report where it was high down to zero. Now guess where those credit cards are again?
Back up.
Now all of a sudden, I can't afford my credit cards. I can't afford this. Unfortunately, in this country, the financial education system is extremely lacking. And, what's the numbers? 50-60% of people live paycheck to paycheck and don't know how to balance a checkbook. Unfortunately, I think that is the case today. And with interest rates and everything skyrocketing, I think over the next 2 to 3 years, we're going to continue to see an increase in defaulted loans. Now, I'm not predicting 2008 by any way, shape, or form. I think we're going to continue to see a steady increase of defaulted mortgages in our space.
Yeah, I think we're seeing credit card balances are through the roof again. I think I heard recently that it's the highest that they have ever been in the history of the United States, which is really kind of scary. I've heard some arguments though, where they say that just because balances are going up, maybe there's this group of population that is, they're leveraging the float that you get out of credit cards, but then they're paying them in full. But I would suspect that's a very small percentage of those people.
Yeah, I think you're giving people way too much credit there.
Yeah. Are we seeing like defaults on credit cards going up significantly? Do you know? Or
yeah. So actually, I have a LinkedIn post coming out that I worked on this weekend. It's a great chart of it maps credit card, car or auto, mortgage, student loan, and other debt. And it's basically a line chart that graphs like where everything has gone, and everything is starting to really get almost a hockey stick, except for student loan defaults, because that went from way up here all the way down to nothing because they haven't had to pay in several years. But auto and credit card are basically hockey sticking up. The mortgages is more of a kind of slow curve. And then there was another chart that showed overall debt. And I think we're over 15 trillion now in just overall debt between student loans, mortgage, auto, and stuff like that, which again, in 2008, it peaked. It started going down. In the last several years, it started kind of tracking back up. That shows where, again, we're at all-time highs in this country in debt. And can people's salaries continue to, pay that? And if we do have any type of job issues, which sounds like the Fed is still wanting to break the job market, it could get pretty ugly pretty quickly.
Yeah. I think it's interesting. So people will generally pay the house first and then pay the car second, and credit cards and other debt comes after that.
It's actually the opposite. People pay their cars first and their mortgage second. Okay. And the reason they do that is because pre-COVID, it used to be cars first, mortgage second, because they need their car to get to work, and you can repo a car pretty quick. To foreclose on a house, is going to take, no matter what, it's going to be at least 6 months. So people would try and play that game. But now, because a lot of people working from home as well, they're like, maybe I don't need the car. Come take it. So
yeah, interesting. Okay. So all right. So the investment opportunity is 8 to 11%, and that's based on what? Is that based on investment size or just
Yeah.
The performance of the fund as a whole or investor class?
So
What
it's
drives that?
basically, yeah, investor class. So minimum investment. At 25,000, you start getting bonus shares where it,
Okay.
it enhances that return. So we have different hurdles where different investment amounts get different returns. And then we also
Okay.
have the ability to, if we do better than we anticipate, issue additional, distributions or
Shares.
dividends. Because it's a Regulation A offering, you can't put that in the offering. You have to basically start with, here's the minimum. You can't provide a guess of, saying, okay, it's 8%, but we think you're going to get 10. It's
Okay.
like, no, here's what are you telling them you're going to provide? It was a real interesting experience having to deal with,
Mm-hmm.
going through this process with having to qualify by the SEC to really understand a lot of the rules and nuances
Mm-hmm.
of what you can say, what you can't say, what you can do, what you can't do. For
Mm-hmm.
example, some funds like a 506c, you might be able to give for the first early investors, give them additional incentive. For us, we
Mm-hmm.
couldn't, because we
Couldn't.
wanted to do that, and they're like, no, it's not considered a continuous offering. So
Hmm.
the way they look at it is, okay, Randy, you talk to me today, and you invest today, you get that incentive. All of a sudden, you wait till Friday and you invest, and all of a sudden, I'm like, oh, sorry, it's gone. Like, there's way too much
Got
gray
it.
that could be done, and they like everything to be extremely black and white.
Got it. So is this an evergreen fund or is it?
Yep. So it is evergreen. So
Okay.
it's open. We plan on continuing to operate this for I'll say perpetuity. And
Sure.
just keep raising money and keep moving along.
Okay. Well, let's talk if we can real briefly. I always say keep it to 30 to 40 minutes, but I've got a lot more questions. So
Sure.
if you don't mind, I'd love to dig in more. So can we talk a little bit about Seveney investments? So,
Yeah.
Oh, that's funny. It just hit me. Seveney.
Ah.
I was wondering what the Seveney was. So
So,
tell me a little bit if you can about Seveney though.
mhm.
How long you guys have been in place? Like what's
Mhm.
the group look like? What's the team look like? Those type of things.
Yeah. So, being a alpha male, when I started this, I thought I could do it all. And
Uh-huh.
from 2015 up through 2019, I was basically doing it all.
Yeah.
And then I started to, so I ran some smaller funds, some 506Cs, and I did a 506B, from 2018 to, 2020, 2021. And also I was working a W-2 at the time as well. And I got to a point where I realized I can't do it all. And I was also making, and again, I had a nice cushy corner office job, top floor kind of. So I was doing
Sure.
very well, but I was actually doing better with my investments. So
Yeah.
I, spoke to the wife and said, hey, eventually I want to kind of move out of W-2 and start my own business. And probably the biggest mistake I made is I didn't bring people on fast enough. And I brought, first person I brought on is my business partner, Lauren, who you know. And interestingly
Okay. Yeah.
enough, the way we met was she had just had her second child. So she was on maternity leave and she started researching. She has a sales background, but she started researching note investing. And she
Yeah.
saw me on a presentation of how to lose money in real estate. I did because I was on one of these webinars with everyone talking about how easy it is and you can make all this money. And I'm the type of guy where that stuff just drives me nuts because real estate is not easy.
Not at
So
all.
she saw
Not
that
at all.
and she was blowing me up on LinkedIn, but I was like at a point where, I wasn't checking LinkedIn. So one of my friends calls me up and says, can you please talk to her? So we get on the call and she is just like loaded and firing questions at me. I'm like, wow, she is awesome. So after a few months, I finally was helping her with her portfolio. I was like, hey, why don't you just come work for me part-time? You're home, you got your kids, you must be bored, or
Yeah.
want to
Yeah.
get your brain working again. So she came on board and, was working for me, part-time. And then she went and was getting ready to go back into the workforce. And that was kind of my, basically, get off the pot type of thing
Sure. Sure.
because she is incredible at what she does, and I was at a point where I had met the requirements for my wife in order to, leave the W-2, kids' colleges,
Sure.
put aside, all these other factors. So we launched the Reg A offering. So her and I, so she's a co-founder. And today we have 2 people on asset management who also manage our portfolio, which we have 100 plus assets in our portfolio right now. We have a in-house accountant, which is awesome because she has SEC experience, so she can file our SEC
Nice.
reports. She works with our third-party auditor. Basically, them two basically keeps me out of it. And anybody who outsources your accounting, I feel for you. I know that pain. And then we have 3 people on investor relations. So we have 2 salespeople who do retail sales, and then we have a investor relations individual. So some people may have like a fund manager, or use hire a platform to do a lot of that back office stuff. We actually brought that in-house because we are type A control freaks, and we want to make sure our distributions go out without a kink. If something gets kicked back for wrong account number, it's not waiting a month. We know immediately. And then just fielding all the questions. Having somebody that an investor can pick up the phone and call somebody that is, here in the States that, understands the offering, can answer the questions. For us, we pride ourselves on customer service and communication. So, and that's when we were building out our team, that's what we were focused on.
I love it. Love it. So it's grown. Was it 2? When did Lauren come on?
So Lauren came on in, trying to think. I'm missing. COVID just blows all the years out of the water. I believe 2020 is when she came on board. So
wow. Okay, so in a relatively short amount of time, 3 years.
3 years from
you guys rolled out the Reg A, and you have, what's the AUM as far as number of dollars in there now?
So we raised a little over 20 million in the offering, and then it's interesting because people are like, "What's your AUM?" And on the institutional side, they look at it in 2 ways. They're like, what's the value of the assets and what's the money that you've raised in the door? So we kind of always are like, which number do you want to hear? So, but yeah, we've raised a little over 20 million.
So I'm thinking if you're paying 9% annualized, you're paying almost $2 million a year in 1099 income to your investors. That's amazing. Absolutely amazing. Congratulations. So and that is not wait for 90 days, 6 months, 2 years before you start getting paid. Like you're talking literally within 45 to 60 days, your folks are earning these dollars.
Yeah.
That's amazing.
And it's interesting because right now, as anybody who's out there who runs a fund, deploying capital is what keeps people up a lot of times at night because it's not only it's not only getting involved in a good deal, but it's finding it in a timely basis. Fortunately for us, we've been extremely fortunate where, we actually have more deals right now than, and again, we're raising, several $1 million a month, which is great, but we're seeing so many deals come across our desk right now that, it's great because we can pick or even be more pickier on these deals. But all of a sudden, and like people ask, if someone cut you a $5 or $10 million check, would you stress that you couldn't get out the door? And our response would be, actually, it's not, because we've had deals where people have kind of said, hey, this is what we want for it. And it's just sitting there. If we want it, we could go grab it, off the shelf at any point in time. So
and you truly do get to pick. You got your pick of the crop essentially every single month on the deals that you're buying, just simply based on number of new investors. You go to your list and take the top 10 deals, whatever it is. That's amazing. Good for you. Well, congratulations. So what's the future look like? You've grown tremendously in the last handful of years. So taking that who, not how mentality to 10X, what's that going to look like come 2025, 2030?
Yeah, our goal is to get to, 150 to 250 million raised. And, we've started playing more on that institutional space. We have a broker dealer we're working with. We have 10 selling agreements. So, we have this cool graph of, us with all the people in a big circle who are helping us raise money, RIAs, investment advisors, working on getting on like Schwab's platform, which got stalled because of TD Ameritrade acquisitions. So, we're looking to grow. And the great thing about note investing is, like our average loan right now is, $160,000. we can keep the same loan count, but increase the loan amount. So, just like, somebody buying, real estate, okay, instead of buying $300,000 houses, I can go buy 600,000. We can do the same thing in notes. So it's not like all of a sudden we're going to have 3,000 loans and we need to add 30 people.
Sure.
We view the company growing to, and they probably 12 to 15 people, probably as we grow, need, some more help on the accounting side and, on the finance side of things, and maybe another asset manager here and there. But after that,
Sure.
we look at our growth of trying to maintain a nice portfolio that can be managed, but just instead of, buying loans that are $120,000, $150,000 balances, just increasing that a little bit.
Yeah. I love it. Love it. So scaling at a manageable level, a smart level, versus just growing just to grow like a lot of people do. So very good.
Yeah. So when I worked my W-2 job, I was actually 2008 to 12, I actually was on the construction company I was working for, a contractor. They were in acquisition mode, buying up companies across the US. And I was part of an acquisition team here in the DC area. And, we were looking at these companies that were in distress. And the issue that every one of those companies had was they grew too fast, too quickly. From 2004 to 2007, they didn't have the right people. They couldn't up-level their people. Their people were great people, but not to take on the amount of work that they needed. And they didn't bring on the right people, and it impacted their cash flow. So having seen how that impacts people is, at front and center in my mind to understand that, you have to have smart growth. You can't have, you can grow quickly. You just got to be very smart about it.
Right. And then the last thing you want is to be those organizations that didn't make it through 2009 to 2012 because they grew too fast on the front end.
Yep.
Right. So, yeah, very interesting. Well, very good, Chris. Well, this has been an interesting conversation, and you've opened my eyes to a whole new area that, of course, I'm going to get excited about and dive into and learn more. But this has been exciting. I do, however, I have a few questions I like to ask everybody, and even though we're running a little bit long, I still want to hear your answers to these. So if you can bear with me as we go through those, I'd love to do it.
Sure.
All right. Well, let's dig in. You mentioned that moment when you had a conversation, I think, with a boss who like laughed at you and then cried and then kind of heckled you a little bit on the back end. With that in mind, what kind of educational resources would you share with a new or newer passive investor so they don't have to get laughed at by their boss in the future and not know about this stuff?
I mean, a lot of people always go back to, Rich Dad, Poor Dad. And
Sure.
for me, working in corporate, always just, I feel like I was, just following the flock of bury your head, the 40-40-40 rule, where you work 40 hours a week for 40 years, get 40% of your income. There's so many, you have to open your eyes and, just try and take on as much knowledge as possible. And with the advent of the internet and YouTube, there's so much information out there that you can gain. And the one thing I'll mention to people is when you go to get educated, you don't need to spend $10,000 on a course right off the bat, because the people who do usually do that too early. And they start with, they don't even know what information they should be absorbing and what information is like ancillary. So, start just educating yourself and figure out what it is you would be interested in investing in. You don't need to follow everybody. You don't need to follow me and be a note investor if it's not your thing. You don't need to be FOMO on short-term rentals like a lot of people were 2 years ago. Do something that fits you.
I love it. And I think really, really good advice. I think a lot of people go to, one of these free events and then they get suckered into buying the weekend event. Then they get suckered into buying the big event. There is so much information in podcasts and books and YouTube, just as you said. Like my experience, I jumped in and I learned a bunch of different things, and I've jumped all over the place first few years that I was there, but I didn't spend $30,000 on a thing, which once you spend 30 grand, you pretty much feel like you got to stay in that area, because that would be a waste of money without it. So I think that's really, really great advice. So now I'm surprised there's a podcast I believe you might be involved with that might be a good spot to learn more about this.
Mhm.
Do you want to tell the audience about that?
Yeah. So if you want more information on no investing, it's called Creating Wealth Simplified is the podcast. It originally was called the Good Deeds Note Investing. So, think and play on words with deeds for house and doing good deeds, trying to
Yeah.
work with borrowers. And, I mentioned, prior to recording, we started that. My partner at the time, Gail, we were just buying loans and we were venting like, back and forth about, this person or that person or this company or this servicer or this vendor. And we basically came to a point of like, we could record this stuff because these stories are just,
Yeah.
it's like watching an episode of, some of them are like watching an episode of Cops or House Hoarders. You're
Sure.
just like shocked at what happens next, or Jerry Springer. So,
Yeah.
people fell in love with it. And we also were providing a lot of free education for people on what to do and what not to do, because a lot of the education in this space is extremely like super high level, 30,000 feet. And
Sure.
just like every guru out there, one of the more well-known gurus end up to be, well, let's just say he ended up having like $2 million in judgments against him for not returning money. So,
Oh,
he's out
goodness.
there training people, but also taking people's money and never returning it. So, it just leaves a real big black eye on the industry. So we were trying to
Sure.
provide that content for people that is just free. Here it is. Here's the truth about it.
Love it. Love it. Yeah. Thank you for that. And I think you mentioned you've been doing this for a number of years. So there's tons of content out there
Yeah.
with
Five
lots
plus
of
years.
episodes to listen to. That's amazing.
Yep.
Yeah. Not a lot of podcasts out there that have been around for 5 years. So hats off to you for sticking with it and doing that. It's not an easy job for sure.
No, it's a lot of work, and you mentioned
Yeah.
you're doing multiple today. This is my, this week I've got like 5 that I'm recording, and it's a lot of work.
Yeah, no doubt. Well, you put a ton of awesome content out there.
Mhm.
I'm going to spend more time with your channel for sure.
Mhm.
Based on what I learned today, I'm sure that'll be time well spent. So, well, let's dig into kind of a fun one. I know you and I are part of a group called GoBundance, and
Yep.
part of that group is to live life big, and bucket list challenges is one of those. So,
Mhm.
is there a recent bucket list item or one that you hope to be checking off your list in the near future?
Ooh, good question. The one that I want to check off next is to do an African safari. So family with an African safari is the next one that I want to check off. So
I love it. Everybody that I have heard that has done that says that it's the single best vacation
mhm.
they've ever done in their life. So
Yep.
my wife and I have that same desire to do that in
Yep.
the next couple of years. So we'll have to stay in touch and talk about that one a little bit more. So
Yep, absolutely.
cool. All right, and then kind of a fun one here. If you had $100,000 today to invest personally, and you couldn't invest it in your own fund, where would you put those dollars today?
It's funny you asked that. I do have some IRA money sitting there right now, and I'm like, ooh, what do I invest this in? So one of the companies that I invested in about 6 months ago. So as part of doing the Regulation A, you have a broker dealer who sets it up for you, and there's
Yeah.
one called Dalmore, Dalmore, Dalmore Financial Group. They do a lot of. They're like the main person people go to get all these set up. So on their website, they have all these crazy offerings.
Okay.
So one of them was this company called Miso Robotics. And what it was is it was a company that created robots that worked in fast food, basically flip the burgers, do the French fries and everything. So it was basically
Yeah.
AI robots to do that. And so I had thrown a little bit of money at them, back in the day and so forth. But for me, I would look outside of real estate because
Okay.
that's and invest in something that's not real estate related. One of the things my wife is investing in right now, so she does like all the stocks and all the other stuff. So she works for an international financial organization. So she gets to see what's going on all around the world and stuff. One of the things
Sure.
that a lot of the international community is very big on is the minerals for electric batteries, and coming up with
Yeah.
the ores and a lot of those. So some of the mining companies that specialize in not just lithium, but there's other types of minerals.
Sure.
I forget the name of them. Is something that we're looking at as well.
Interesting. Okay, that's the first time I've heard robots in fast food or minerals, maybe mineral rights I've heard. But yeah, that's interesting. There's so many different places to get started.
You think a real estate guy would say real estate, but it's there's lots of other things you can invest in.
Absolutely. Yeah. And you've got to have a little bit of money that you're just kind of playing and speculating with as well. So that's where
seriously,
you get the biggest
check out
returns.
that downward page though, because you can invest in like fractional in racehorses. So you can invest and you can do it for like $500 and invest in just a racehorse. There's short-term rentals where you can do fractional. So one of the big things about this Reg A is fractionalization of investing in a portion of an asset. It's pretty cool.
I love it.
Not sure if you'll make any money on it, but it's cool.
And it's not the stock market, and it gives you access to alternative investments that most people never even knew about.
Exactly.
So yeah, very cool. I love it. Well, Chris, thank you so much. This has been a lot of fun. I've learned a ton, and I think it's really just the tip of the iceberg of my journey with note investing. But thank you so much. I really appreciated the conversation. It's been a lot of fun.
Well, Randy, thanks for having me on. It's been a pleasure.
All right. And to our audience, I would say thank you again for joining us today. And as always, continue your education journey in passive investing. But more important than that, make the decision to invest in your first passive investment. I'm convinced that once you start, you'll wish that you had started so much earlier, because decreasing your dependence on your W-2 is not going to happen from the stock market. And I believe the best place to do that is in commercial real estate, and now potentially note investing as well. So thank you guys again for joining us today. Join us again next Thursday for another great episode, and be sure to like and subscribe to the channel. Thank you so much.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.